Welcome back, everybody. Today we're talking about Nike, the shoe dog phenomenon that turned into a dominating global brand and proved that sneakers can be big business. And the company that probably got about 40% of my paycheck when I was in high school and college. Okay, maybe up until the time that I was an adult. Okay, maybe I'm not quite an adult yet, but...
Stop it. Get some help.
Over the past 20 years, Nike has about tripled the total return of the S&P 500. They've showed good, consistent dividend growth, and their sneakers are now more protected in stores than designer clothes. Go figure. So is Nike stock a buy right now? Let's find out. So before we dig into the business, let's look at some basics for Nike. So if we jump into Seeking Alpha, we see that Nike is currently trading at a price of $97.67. Over the past 12 months, it's actually down 10.17%, and year to date, it's down over 17%. Nike currently pays a dividend of $1.36 per share, which equals a 1.39% dividend yield. And if we look at the dividend summary, we see that their payout ratio is a little bit over 41%. They have a 5-year annual dividend growth rate of 11.2% and consecutive years of dividend growth at 10 years. But actually, if you look at the history, it's more like 20 years of dividend growth. So I'm not sure why those numbers are off, but obviously Nike's grown their dividend pretty consistently for quite a while. Now, if we look at Nike's dividend growth, we see that in the 3, the 5, and then 10 year, it is double-digit dividend growth, and that's very good. And if we look at how the stock has performed against the S&P 500, we see that it's just about tripled the return of the S&P over the past 20 years. If you go down to the 10, they're pretty much neck and neck there, as Nike's brought down quite a bit since 2021. And then over the last 5 years, Nike's actually underperformed. All right, so we have an idea of what the stock is doing and how they performed. Now let's talk a little bit about Nike's business. And Nike's the largest shoe and athletic apparel manufacturer in the world, with over $50 billion in revenues and more than 83,000 employees. They also house one of the most iconic sports brands and figures in history in Jordan Brand.
A shoe is just a shoe until somebody steps into it.
And that was a great movie, by the way, especially if you're into sneakers or Jordan or just basketball in general, but I digress. And part of the reason Nike is such an iconic worldwide brand is that it's linked to some of the biggest names in all of sports, including, of course, Michael Jordan, Cristiano Ronaldo, LeBron James, Serena Williams, and Tiger Woods. Nike has continued to have top names attached to its brand over the years, and that has contributed greatly to the company's image and brand reputation. Okay, but how does Nike actually make money? Now, their revenues are broken down into the following categories. One being Nike brand revenues, and then the other kind of being not Nike brand revenues. But the Nike brand revenues include footwear, which is pretty self-explanatory, and that accounted for 65% of the revenues in fiscal 2023, with a little over $33 billion. Next is apparel, which accounted for 27% of revenues in fiscal 2023, and accounted for $13.8 billion. And then there's equipment, which accounted for 3.3% of the revenues in fiscal 2023 and about $1.7 billion. And then the last part of the Nike brand revenues are the global brand divisions, which includes Nike brand licensing and other miscellaneous revenues. This accounted for 0.11% and $58 million in fiscal 2023. And now in the non-Nike brand revenues, you basically have two categories. You have one, Converse, and Converse accounted for 4.7% of the revenues, about $2.4 billion in fiscal 2023. And then lastly, you have the corporate revenues, which primarily consists of foreign currency hedge gains and losses. Now this accounted for 0.05% or $27 million in fiscal 2023. Additionally, net revenues are broken down by geographic area as follows. You have North America at 44%, EMEA, which is Europe, Middle East, and Africa, at 28%, Greater China at 15%, and APLA, which is Asia Pacific and Latin America, at 13%. And I must say, Nike has one of the cleanest and nicest looking 10Ks that I've ever seen, and I know that means absolutely nothing as it relates to evaluating them, but I do appreciate it. And now if we look at Nike's revenue growth, you can see that it's 9.65% or just about 10%, and that's higher than their 5-year average of 7.19. Now at first glance, having revenue growth at about 10% year over year is pretty good, but when you look at the quarter by quarter numbers, it's only about 3.5%. Now normally I would say that doesn't really matter since revenues are typically seasonal, but when you look at the previous year quarter over quarter, it was actually 12%. And now I know you might be like, okay, that's kind of reaching where you're saying quarter over quarter doesn't matter, but then you're comparing the quarter over quarter to the previous year's quarter over quarter, and is that really even a thing at all? It may not be, but when you combine it with a couple other things that we're going to talk about related to margin, it's just something that I want to keep watching. Now to get a deeper look at the revenues, let's look at the breakdown of the wholesale equivalent revenues by product segment, which we see breaks down like this. You have men's, which is 52% of the revenue and growing at 10% year over year. You have women's, which is 22% of the revenue and growing 4% year over year. You have Nike Kids, which is 12% of the revenue and growing 3% year over year. Then you have Jordan Brand, which is only 16% of the revenue, but it's growing at 29% year over year. And then lastly, you have others, which basically includes adjustments and other products, but that was actually negative. It was negative 2% of the revenue, but when you add them all up, it equals 100. So clearly, Nike's bread and butter is men's, which includes products that are also unisex, and Jordan Brand. And we'll talk about this here in a little bit as it relates to competitors and how they stack up. So if we take a look at Nike's net income and free cash flow growth, their free cash flow growth has been actually pretty good, 10% year over year. Now this was primarily due to a reduction in customer accounts receivable and selling more inventory than they bought this last quarter, but it's still good performance when you consider that net income was actually down year over year. And this showed up in two different ways. You had cost of revenues, which was higher, which was primarily driven by higher product input costs and elevated freight and logistics expense. But you also had higher SG&A, which was primarily due to wage increases, variable Nike direct costs, and increased demand creation costs, which includes things like advertising and endorsement contracts. And on their most recent earnings call, they mentioned that they expect demand creation costs to grow slightly above revenue as they increase investment, as they say, to support key global sports moments and product launches. And with those expenses in mind, let's take a look at Nike's profitability real quick. So if we look at Nike's profitability, we see their gross product margin is 43.52%, which is quite a bit above the sector median, but is slightly below their 5-year average. And when we look at pretty much all their profitability metrics, it's going to be that same type of story. Nike has a net income margin of 9.9%, which again is quite a bit above the sector median, but below their 5-year average. And then their levered free cash flow margin is 7.56%, again, quite a bit above the sector median, but also below their 5-year average. And one of the ways that Nike's been working to improve their margins is concentrating on what they call their Nike Direct strategy. And this is transitioning sales from being primarily wholesale to being more direct to customer. And direct to customer means sales related to their website and digital presence, as well as their own Nike stores. And as of this past year, Nike Direct made up 44% of their revenues, with wholesale still making up 56%. And now we just talked about, as it related to net income, that their cost of revenues and SG&A have been going up. So obviously their margins are going to go down a little bit. And now in general, part of the push to more direct-to-consumer sales is that those Nike Direct sales are higher margin than wholesale revenues. And Nike has seen that uptick in revenues due to Nike Direct, but because of rising costs, they haven't yet seen that uptick in margins. And just real quick, let's take a look at Nike's debt situation. So if we look at their debt situation, Nike has about $12.1 billion in total debt. But if we look at their cash and short-term investments, it's about $10.7 billion. So that adds up to a net debt position of less than $1.5 billion for a company that's generating about $2 billion in cash flow every year. So that's pretty healthy. All right, so at this point, we have an idea of who Nike is, how they make their money, and how they're performing as a business. But let's talk about some risks to their business. So one, a slowing economy could impact sales and or continue to push down margins. Now, a slowing economy would impact Nike at least partially, but they've been able to maintain growth in the past by pulling some levers. The question is going to be whether people view new athletic gear and shoes as a necessity, an affordable luxury, or just a discretionary purchase that they don't need to make. Now, Nike's increased costs of advertising and increasing product markdowns are example of levers that they can pull, and they have already, which means that, margins could or should improve as the economy improves. But it also means that if the economy goes the other way, then those margins could shrink even more. Risk number two, Niche competitors with higher margins could take market share with differentiated products, branding, and customization options. Now, Nike is by far the market leader in their industry, doubling the next biggest competitor, which is Adidas, in yearly revenues. But there are multiple niche competitors that have gained in popularity and operate with higher margins than Nike. Lululemon has shown extremely strong revenue growth with margins that outpace Nike at pretty much every level, from gross profit to net income to free cash flow. And additionally, Crocs has shown similar growth and even better margins. And while neither of these brands are strong as Nike and Nike's primary segment, which is men's and Jordan brand, they have established themselves in other areas. Lululemon is extremely popular with women, and they've established themselves as a luxury premium brand that people are willing to pay more for. And Crocs has continued to rise in popularity with kids, especially with the infinite customization and personalization options that their Jibbitz provide. Now, neither of those brands can compete with the scale and breadth of what Nike offers, but they can slowly take market share from certain groups that would hurt Nike's overall revenues and growth. Risk number 3, dependence on foreign geographies for manufacture and sales could increase uncertainty depending on world events or economies. All of Nike's products are manufactured overseas, and over 56% of their sales are outside of North America. Now, while it shows the strength of Nike's global brand and their sales opportunities, it also adds some uncertainty into their business, especially as it relates to manufacturing. Economic, political, and cultural issues could have an outsized impact on Nike's operations, especially if related to the manufacturing of their products. They've taken criticism in the past over their labor practices, but in general, operationally, they've managed this issue well enough so far. But it's a risk to consider based on the structure of their business operations. All right, so we have a pretty good idea of what's going on in their business. Let's look at their valuation. So if we look at our spreadsheet, we see the data that's been pulled in. Their dividend growth has been excellent, over 10%. On multiple timelines. Their years of dividend increased. Here it says 10. Again, I think that's actually 20, but either way, it's good. Their dilution trend is down. They have a wide moat according to Morningstar, and they have outperformed the S&P 500, which we've already seen. So now if we take a look at our discounted cash flow measure, once we add our cash from operations, our capital expenditures, and our stock-based comp, we see that we have a fair value price per share of $57.59. Now, that's quite a bit below the $102 that it's currently trading at, but let's take a look at some assumptions and try to figure out what's going on. So in terms of starting cash flow, I used the average as opposed to the trailing 12 months, only because there's been some variability across the different years. And in general, in those cases, I like to use the average just because I think that's a little bit safer. Now, in terms of starting growth rate, I have 12%, which is obviously quite a bit higher than the calculated growth rate. But if we look at the operating cash flow growth year over year and the 5-year average, it's a little bit over 12. So I just decided to use that. We have a terminal growth rate of 2.5 and then a required rate of return as 12%, and then obviously a 20% margin of safety. Now, ultimately, I think my assumptions are pretty reasonable here. It just turns out that, at least from a discounted cash flows method, the stock looks relatively overvalued. But let's take a look at the multiples method and see what we get. So in the multiples method, I'm using these peers: Skechers, Crocs, Deckers, Lululemon, and Under Armour. So after adding our peers and calculating the price to cash flow, we get a fair value price per share of $81.14. Now this is a little bit closer, obviously, to where it's trading at today, but let's look at the price to earnings one and see where that gets us. So now if we look at price to earnings with the same peers, we get a fair value price per share of $54.91. Which is actually closer to the discounted cash flow method than the other multiples model. So if we take a look at them all together, we see that the current price is $102.36. The analyst mean price is $126.29. And then all of our valuation methods are quite a bit lower, and in some cases, like significantly lower than the current price and the analyst mean price. So in these cases, and usually all the cases, I like to look at historical price metrics just to see if that tells us something different. So if we look at the historical price metrics, we see that price to earnings is a little over 30 right now. And in general, I would consider 30 to be pretty high. If you look at Nike's history, these value ranges here, PE is about 25, maybe 26. Even here, it's about 25. So it seems like Nike's kind of value range for price to earnings seems to be about 25. And so we're a little bit above that, obviously, since it's 30 right now. But now if I look at price to cash flow, it's actually about 25. And that historically actually looks relatively undervalued, which is interesting So if we look at it here, it's March 2020, right? Which is obviously a huge macro event in the market. And even in that event, price to cash flow was 23 and price to earnings was 25. So when you look now and you say, well, price to cash flow is 25, it actually doesn't seem all that expensive just from a historical price metric. But in terms of price to earnings, it seems like there is a little premium there. So how I would approach something like this is I would err on the side of caution. And what I mean by that is price to cash flow actually looks pretty attractive based on historical metrics, but the cash flows have been a little bit inconsistent. And it just happened to be that there was a very good cash flow quarter. And we talked about earlier that was primarily driven by change in inventories and accounts receivable. So that would be something that I would want to see again for another quarter at least to see if it actually is cash flows rising or if it was just kind of an anomaly. So what I would take away from this is that Nike seems, at least to me, to be trading at a premium across all valuation methods and price metrics. Okay, so let's go ahead and score Nike on the 3 characteristics that I use to evaluate stocks: business, operational performance, and valuation. So for business, Nike has iconic brand power. They have revenue growth at about 10%, and they do have some niche competitors, but in general, they're the market leader. So on a business side, I would rate them as good. So in terms of operational performance, Nike has dividend growth that's greater than 10% on multiple timelines. They have low net debt, but they do have margins that seem to be decreasing with some economic headwinds coming up. So in terms of operational performance, I would just rate them as okay. So in terms of valuation, the DCF model returned a fair value price that was 56% of the current price. Both of the multiples models also returned fair value prices that were quite below the current price, and even the pricing metrics, especially price to earnings, seem elevated. So from a valuation perspective, I would rate them as poor. So is Nike a buy now? So for me, Nike is a hold right now, not a buy. So while there's areas of their business that I really, really love, there are a couple things that I have some questions and concerns about that I want to wait and see on. Nike is an iconic global brand that is far and away the leader in their industry. While they maintain some pricing power due to the strength in their product lineup and high-quality endorsers, footwear and apparel retail is a tough business, and that could be impacted by a slowing economy and more niche competitors that target a part of their customer base like Lululemon and Crocs. And again, neither of those companies can compete with Nike on a broad scale, but what they can do is chip away at certain parts and segments of their customer base that are more drawn to the premium branding of Lululemon or the infinite customization and personalization options of Crocs. And I know that might seem like a small thing, but to me it's important because it clearly differentiates them in the market. And when we're talking about people having to make choices when it comes to what they're going to spend their money on, that definitely matters. Up to this point, though, Nike's growth year over year has been good, but it seems to be slowing in the most recent quarters while costs and expenses have risen. And now that's something that I just want to keep monitoring to see if it's just a blip or a trend that's going to continue. Which also goes for margins as well. Even if they expect SG&A to rise, what I'd like to see is a shift to more Nike direct revenues to help improve margins instead of having them continue to decrease. And ultimately, Nike's valuation right now isn't at a place to where I'd be willing to overlook those two things. But Nike's core business is unique, and it usually trades for a premium because of that. And with dividend growth over 10%, it's the type of stock that I'm usually interested in. But for me, at least right now, I want to see what happens with their revenues, margins, and valuation, at least for another quarter or so. So what do you guys think of Nike? Are you buying? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.